This is our Forex blog for May 10th, 2013, and it will be a short blog because it's after markets have closed on Friday, and obviously you can guess that I don't want to be working on Friday night. These are our currency indexes, which show you basically the trend of each individual currency, the dollar. We compare all the dollar pairs, and we let you see whether it's going up or down based on the synthetic chart that we create. We let you see the upper and lower containment bands on the dollar, the hourly moving average in gray, the 15-minute moving average in green, the previous day's high in dotted green, previous day's low in dotted red, and like we've done for the last couple of years, all of our currency meter type tools work on the synthetic currency. This is our FX trend intensity, which measures the statistics of how strong each move up and down is. And when you clearly see moves at and above the 80 level, followed by pullbacks with very little weakness in comparison to the strength, these are trends that are very likely to go up. So you can see up moves, considerably more strength than the down moves, and that's a trend that's very sustainable. And once you see extreme weakness, then at this point the trend's probably over. If it goes up again, you can consider looking for sells. The daily, weekly, monthly trend is on the bottom. So basically, in a nutshell, what you want to do, it's simple. Find the strongest currencies and look to sell them versus, find the strongest currencies and buy them versus the weakest ones. Or if the top currency is the weakest one, like the Australian, if it's going down and the dollar's going up, then you're looking to sell the weakest versus the strong, the Australian dollar. Let's take a look at the Australian dollar. This is one that you'd be looking to sell on any up move today. And you can start last night. Oops, that's not what I meant to do. You can basically draw trend lines on up moves and look to sell them. A little sideways consolidation, rectangle pattern breakouts. My preference is to wait for a 10 to 15, 25 pip pullback. And these are pretty high probability places to sell, especially when it's at the upper containment band or upper Bollinger Band on our perfect oscillator. Very high probability. And when you have a downtrend like this and the perfect oscillator hits or goes above the 80 level, which is an extreme, you can just pretty much sell it on the close of this bar. And you can see in this case it fell a nice 50 pips in less than an hour. Very high probability. You can see the same, something similar here, although that pullback was only about 10 or 15 pips. Here you have a loss, here you'd have about 15 pips. So this is one example of currency to be focusing on with the dollar today. The Swiss was pretty much going sideways and then broke down from above to below the hourly moving average at 3. The daily trend's down, the weekly trend's very weak. So the dollar Swiss is also an excellent one to be buying, especially after 3. You can see the chart here at 3. Breaks out. This is very likely, and when it's above the upper containment band, the perfect oscillator is at an extreme. Basically what it means is this move up at 3 was one of the biggest moves at that time of the day in the last 20 days. It's significant. It's very likely to continue. However, as soon as it kind of runs out of steam, I would get out of it when it goes underneath those bars low. You would put your stop right underneath the swing low, and so this is how much your risk is, and this is how much you made. And you can see it's about 1.82 times bigger than the loss, than your risk. You got this nice little pullback right here, and what's nice about that second pullback is you have your fib targets up here. And anytime it's above our 2.0 white band, if it kind of comes up really close to this area, don't be a stickler and wait for it to hit this area. One of the reasons why we have some other fib areas on the chart is so that you can see when the market's at an extreme, sometimes it's not likely to hit the 1.382, but you can see it tagged the, I think, 1.24 something fib, which some traders ask us to put in, and we visualize it on the chart without putting the levels on it. If the market's up or down too much, that's probably the area where it's going to run out of steam. This trade right here is a little iffy because it's above our upper containment band. And you can kind of wait for price to get above the 80 level here and just get out of the trade. You also have a nice little kind of wedge pattern right here. Anytime volatility goes through the roof and then gets smaller and it's bouncing around, the breakout of that's pretty high probability too. That's another one that you could have traded the dollar against. Let's scroll through this and look. You can see the New Zealand, the daily trend's down and the weekly trend's down. Here's the hourly moving average. It's underneath the hourly. It's also underneath the point of control. This is the price that most traders had positions in yesterday in the New Zealand. So anyone who bought yesterday on average is long at this price. When it's underneath there, it's going to add fuel to the down move. You can look for sells in the New Zealand dollar all day. And you can use any time frame chart. I'm just using 5 minute because it lets you see the entire day. Trades today in this one. And you can just simply get out of these every time trend lines are broken. A lot of people do that. These are 15 to 25 pip moves. Stops always above the swing high. And if you notice on the chart, most of the time it hits the lower 2.0 band, and sometimes it goes a little bit underneath it. You get a nice bounce off of those. So don't be greedy. Use the perfect oscillator when it's at or below -80 to consider getting out of the trade. And as you can see, most of the time that's where the price is going to reverse. And if you're an aggressive trader, what I like to do is draw your fibs on a decent sized move. Fib targets are down here. When it's underneath the 2.0 white band, perfect oscillator is -80. You can look to get into nice little counter trend trades and oftentimes make 15 to 30 pips or risking 10. I usually scale into pretty big positions there and get bounces. It's wonderful for US traders who might have missed the trend move and want to trade counter trend but don't want to get burned. Most of the time, most people who do counter trend lose their shirt. Our counter trend methods are, I think, one of the best winning percentages of any you'll find. And these tools can be used for predictive purposes too. For example, you can draw trend lines underneath the up move, and when it's gone to an extreme at the upper band and then breaks down through the trend line at 8 o'clock, it's a pretty high probability one to sell. So what one is likely to go up at 8 o'clock? Well, this one's underneath its previous day's low, so I would probably avoid that. This one at that time is finding support at the previous day's low. At 8 o'clock, the euro has been kind of trending, it's been mostly going sideways, but the daily trend and weekly trend's up. It's not at an extreme near the upper band, and you can certainly look for and wait for a breakout of that upper trend line here at 8:30. If you wanted to be safe and wait for that trend line to be broken first at 8:30, you can see that this one's already broken down at 8, but at 8:30 it's also going down. You can buy the EURCAD at 8:30. It's that simple. And when one currency is going up and the other one's going down, you're probably going to make 20 to 50 pips. So if you look at the EURCAD here at 8:30, it's probably going to go up 20 to 50 pips. Here's 8:30. You can see 1.3110, and it went up to 80. So it went up 70 pips. Very high probability, and you knew the CAD was trending down back here at 8. So if you're really aggressive and you saw this little breakout of this little highs here, and you saw that it had gone down an extreme amount and made a lower low and another lower low with higher indicator values, that's called divergence trading. And again, our lower 2.0 band did an excellent job of telling you, hey, stop trading with the trend and look for counter trend, because sometimes you're going to get these huge astronomical wins, 100 pips up, and very predicted using our lower containment bands. If you scroll back and look at this chart, notice how many times the 2.0 band gets hit. It's amazing. It came down very close to it here, went up, hit it here, went down, hit it here and bounced, then hit it here and bounced. So, don't trade against statistics. The biggest traders in the world know the volatility and patterns of every single currency. They have advanced mathematical models that tell them when the trend's gone too far and to lighten their positions or exit their positions. And so these are the places where if they were short, they're looking to get out by buying. If they are long, they're looking to get out by selling. And that's why these work so well. And used with conjunction with our perfect oscillator, which is a completely separate tool, has nothing to do with the containment bands, you will add to your probability even more.